Welcome back. You're watching Editors Roundtable on CNBC TV 18. Well, the Reserve Bank of India has moved 100 tons of gold back to India from the United Kingdom. But what does this mean for you and me? Prashant decodes that for us. He's walked across to the wall. Prashant, over to you.
It's an interesting news item, isn't it, right? It's a headline grabber, 100 tons of gold being brought back to the country. This is, of course, our own gold, RBI's reserves, and this was lying in the UK in vaults, which has now been brought back to the country to be stored here. So it makes no real difference to the price of gold if you're thinking about it that perspective, or to the economy or anything of that sort. This is just reserves which we already know about. Out of the 800 tons which RBI has as gold reserves, 100 have been brought back from overseas back to the country. This is essentially RBI's gold holdings, right? As of 2024, this is all March, 31st of March ended, and you can see how this number is kind of increased to about 822 tons of gold. Now, the question is, I'll get straight to it. Storing in India, or rather storing at home or storing overseas? That's the big question. And what I want to put together, what I want to put out is basically the survey from Invesco Global Sovereign Asset Management Study of 2023. This was an interesting report. It came out in July of 2023. And Invesco basically surveyed 57 central banks, global central banks. And they also surveyed lots of, big CIOs, basically overall assets under management of some $21 trillion. For our purposes, the interesting bit, of course, is the feedback from central banks, right? And this is what the report found with respect to what we are talking about. They said that gold allocation is likely to increase over the next 3 years. Most who were surveyed anticipate this. Not one central bank surveyed anticipates a decrease. So central bank demand for gold is likely to remain very, very strong. They go on to say that wars and US freezing of Russian reserves have prompted a flight to safety. This is a lesser talked about kind of event which really shook up financial markets and how some of these things were really conducted. Never before in the history, because of war or whatever else, had the sovereign reserves of a country been seized by other countries overseas. And what this has sparked off is, of course, the fear that the US, especially because it has a reserve currency, can weaponize the reserve currency status. It's sparked a flight of safety into gold, and also bringing some of this gold so that it's with you in your own country, and it can't be seized or whatever else. I'm not saying that these were the motivations for the RBI to do what they've done, but this is interesting, especially because the report and the survey with so many central banks highlighting this really points out. They say that they prefer, and this is all central bank feedback, they prefer physical gold as compared to gold ETFs and derivatives. They continue to say, and this is, by the way, an interesting comment. This is a comment from a Western central bank, and I just want to read this out for you. They don't name which is the central bank, but they say, we increased the exposure to gold 8 to 10 years ago and transferred gold reserves back to the country. We did have it held in London and could use it to enhance yields and for swaps, but now we've transferred it back to the country to hold as a safe haven asset and to keep it safe, right? The question of keeping your own reserves safe from the kind of activity you saw back when the Russian reserves were seized, did not arise before that, but I think it's really something which is on the minds of a lot of central banks, as this survey indicates. This is a question which they asked: physical gold held in your own country, and this is the report on the central bank feedback. In 2020, there was 50%, 68% now. In 5 years' time, that number now at 74%. Just leaving you with 3 other points. The record buying of gold really happened in 3 phases. The first one, of course, was in 2014 with the Russian annexation of Crimea. And there were sanctions which followed on Russia. Then, of course, there was the US-China trade spat. China has been a big buyer of gold. And, of course, the latest is when the seizing of these reserves really happened. Forecasts for how much gold central banks would buy: over 1,000 tons this year in 2024, right? So that's big. Central banks are now absorbing between 25 and 27% of annual gold mine production. And remember, gold production goes up 1.5–2% every year. Central banks are now buyers of about a quarter or more of that particular production. And post-COVID, buying is led by China, but also includes a variety of emerging markets and some developed markets as well. So, the marginal buyer of gold is not just retail, and that demand, of course, is there, but central banks also really big buyers now. Anish, you guys run that multi-asset fund and you've been sort of propagating that. It's done phenomenally well, not least because of gold. Your thoughts?
Yeah, so, what is interesting is if you look at when gold was weakest, it was post the disintegration of the Soviet Union when the Cold War ended and, people started trusting each other. So central banks actually sold gold and built a lot of reserves in US dollars. Obviously, if geopolitical tensions rise, you're seeing a reversal of that trend. And that does mean, what that means is central banks hold more gold, central banks hold less of, let's say, US dollars or European currency as reserves. And that does mean higher interest rates in the developed world, because this was effectively free financing that the reserve holders were providing to the hard currency issuers. So it does mean that we hold more gold and rates in the developed world are higher.
Stay a little higher.
Stay a little higher.
Okay.
Anish, the other big, touching point or a big question in the mind of the investor is the fiscal discipline as far as India is concerned. Your thoughts on what should, be the right path, growth versus, fiscal discipline?
So look, as the economy is picking up, fiscal policy should be counter-cyclical, right? So the temptation will be that tax revenues are rising, we can afford to spend more. But that would be a mistake, right? That is actually the mistake that happened between 2009 and 2013. See, in the global financial crisis, the government gave a big stimulus, the economy recovered, but that stimulus was not withdrawn. And that led to an overheating of the economy. So at this time, with tax revenues rising, is the time to be disciplined on spending, not to be expanding spending. That is something that I would at least be.
Which is what the RBI and the monetary policy has been doing, right? Monetary side has been doing counter-cyclical policy.
And the fiscal should also remain counter.
Should remain the same.
Okay. That will give RBI room to take a slightly easier stance. If fiscal is loose, then RBI will have to be very tight.
Okay. By the way, guys, it's almost time to wind up, but we're not done, right? We have Saturday night action coming up on
Sunday morning
the
action.
exit
Sunday
polls.
morning, Sonia.
Sunday morning as well.
Sunday morning as well. So, Prashant, I heard you're coming in on Sunday morning.
I am.
So, in case you miss Prashant, don't worry. You can see him on the weekend also.
That's of course with the Monday and Tuesday. Monday, of course, exit polls, and then Tuesday
Then
the actual
Tuesday.
result,
Yeah.
which is going to be like full budget style programming. So it's going to be a big one.
Yeah, it's going to be a big one. So, well,
Sonia, where are you
keep
going
it
to be? I'll
glued.
see you here.
She's actually on a break, I guess, right? Enjoying overseas.
I'm going to watch you. I'm going to watch
So
you.
all the rich people, Prashant, in this time, in summers, they go all go abroad. So
where are you going?
I'm not
Where are
here.
you going,
I'm not going anywhere.
But, well, thank you, Anish, for joining
My
us.
pleasure.
Thank
Thanks
you.
for having me.
With that, it's a wrap on this edition of the Editors Roundtable. But stay glued to CNBC TV 18 for all the news and updates.